Hi everyone, welcome to today's video. So just last Friday, the Indian markets corrected quite a lot. And there is a lot of panic going on that, markets are going to correct quite a bit from this point on, and we might hit even 15,000 levels. Why is this conversation getting restarted? It is simply because of the interest rate debate that is going on in the market. Now, the problem is that we don't like to understand these type of complicated macro concepts. So every time there is a market fall, we just blame it on some macro factor and be done with it. On this video, I'm going to help you conceptually understand how interest rate moves the market. If you like the analysis, do press the like button. In fact, please press the like button so these type of fundamental videos reach out to more people and they become financially aware. This video is not for you if you're just looking for some quick stock market money making tips. That is not what the goal of this video is. I'll help you understand systematically as to how interest rate impact the stock market and why do I feel that the markets are not going to correct by a lot. So let me start that conversation by telling you a very quick story about North Korea. So if you are a tourist in North Korea, what you will figure out is that there are very few airlines that fly to North Korea. When you land in North Korea, your tour is arranged by the North Korean government. You have to go in front of the big statue of Kim Jong-il and you have to put your offerings there. Even the state decides which hotel you can stay, what type of tour buses you can go, what type of events you can attend, etc. etc. Now, my hypothesis is that something similar is happening with the stock market. The governments all across the world, they move the interest rate in a certain way, which impacts how much money gets into the stock market and how that indirectly impacts the stock prices. So I'm going to put a very simple macro discussion. You don't need to know any macroeconomics, finance. All you need is a little bit of common sense, and here are these 6 points. You will understand the entire story. And also I teach a lot of macroeconomics on my stock market course. It's a live discussion oriented course, so you can consider joining that. The link is in the description box and you can check further details. So let us kickstart the conversation, and the first key point that you need to understand is the meaning of interest rate. Now, when you hear the word interest rate, it has many meanings in finance and economics. For example, interest rate could mean nominal or real interest rate. It could also mean your savings account interest rate. It could also mean your home loan interest rate. It could also mean your repo rate interest rate. So when we say interest rate in context of stock market, which rate are we concerned with? Now, what is the exact meaning of repo rate? Let me explain that by using a very simple example. And here is the standard definition of repo rate. So you can just pause the video and read through it once. So this is how the chain operates. Repo rate simply means it is the rate at which the RBI decides to lend money to commercial banks. For example, commercial banks would be banks like HDFC Bank, ICICI Bank, and RBI is the central bank. It does not have the time and energy to go and give loans to people like Akshat. So I cannot approach RBI for a loan. I will have to go through whom? I will have to go through banks like ICICI and HDFC. They in turn are borrowing money from RBI. So repo rates of, let's say, 3%. What would that mean? It would mean the rate at which RBI is lending out money to HDFC Bank and ICICI Bank. Once HDFC Bank and ICICI Bank borrows that money, it will give to people like you and me and will do something called as retail lending or commercial lending. Now, in this simple example, if RBI is lending money to HDFC or ICICI at 3%, then probably HDFC and ICICI will lend to us at what rate? At approximately 4% rate. So this becomes the entire chain that the RBI can decide. It can move this rate called as the repo rate. It can bring it up to 4. Then what would happen to the loan that is given out to us in form of home loan or car loan or FD interest loan? It will also rise. So if the RBI is changing this number from 3 to 4%, then this number is also likely to change. Similarly, if RBI brings this number down, then again, this number is likely to change. So I hope you understand very categorically what repo rate is and how RBI can shift that repo rate to change the rates of home loans, car loans, and all the other different types of loans that are out there. So now comes the natural question that, okay, if RBI is changing the repo rate, then how would it impact the stock market exactly? So let me give you 2 examples there. So first comes from the US, and here is a chart that you can see, and what you will notice is that from 12th September to roughly 21st September, the markets continued to fall. Why did the markets fall? Because the speculation was that the Feds or the US Fed is going to increase the repo rate or their internal Fed rate. And in fact, the meeting took place on 22nd September and Feds decided that, hey, we are going to increase the interest rate to 0.75%. Now, please notice that stock markets are forward looking. They try to anticipate what is going to happen in the economy. It's not as if that today Fed is making the announcement and from tomorrow the markets will go down. It might not not happen, but the markets will always try to factor 1 or 2 weeks in advance what is going to happen subsequently. So in this example, the market started to fall from 12th September to 21st September. Why? Because the markets were expecting a sharp increase in interest rate. Now example number 2 comes from India. Right now the markets in India are anticipating that RBI is also going to increase the interest rate by 0.5%, and therefore the markets are falling. Now you would have a counter question to me that Akshat, you have been very bullish about the market, you have been investing a lot of your money in the market, then suddenly why are you changing your tune? That interest rates are impacting the market. So let me help you understand this point better by doing a situational analysis. Now here there are 3 kind of stories that can play out. Number 1 story is that no one is expecting that the interest rates will go up. Then suddenly Feds and RBI decide that, you know what, we are just going to increase the interest rate. Then in such a situation, what is going to happen in the market? The markets are going to fall quite aggressively. Why? Because no one is expecting the Feds to increase the interest rate. And out of the blue, they have introduced uncertainty by increasing the interest rate. Therefore, the markets fall. Second scenario could be that people are already expecting the interest rates to go up, and the interest rate go up also. For example, right now the Feds have increased the interest rate. RBI is also being expected to increase the interest rate. So here what is happening is that everyone is expecting the RBI and Feds to continue to increase the interest rate. This is not a shock to the economy. Therefore, the fall or rise of the market will depend on interest rate increase expectation. For example, if everyone expects the RBI to increase the interest rate by 0.5%, but they end up increasing it by 0.75, then there will be a little bit of decline in the market. But if the expectation of increase is very similar to the increase that RBI or Feds actually end up taking, then it will not impact the market too much. Third scenario is that people are expecting interest rate to go up, but Feds, rather than increasing it, keeps it constant or decreases it. Then in such situation, it becomes a favorable news to the market and the markets start to run. So then comes the natural and the most obvious question that, okay, what is the need of going through all this theatrics of increasing the interest rate, decreasing the interest rate, increasing it too quickly, not increasing it? I'm just getting mad. Why is this happening? Why is this happening? Okay, so here is a simple 2-word answer to that scenario. It is called as liquidity management. Now, what is meant by liquidity management? For example, take a look at this particular chart. What you will observe is the rate at which the money was printed in the US. And you can see a very clear spike here in terms of the money that was printed. Now, when excess money is printed, this is called as quantitative easing. This is one of the forms of quantitative easing. You don't need to get into the macroeconomics behind it. Now, if there is more money that is printed, what would happen in the economy? Then a lot of money is flowing through the economy. Now, if too much money is flowing through the economy, what is going to happen? The inflation is going to rise. It simply means that let's assume that in your office, everyone gets a salary of 10,000 rupees. Then suddenly next month onwards, what happens is that your boss says that, you know what, I'm very happy with how everyone is doing the work. I'm going to increase the salary of everyone in office by 10x. So everyone is going to start getting 1 lakh rupee salary from next month onwards. Now, what is going to happen in the office from next month onwards is that a lot of people are buying new cars, new phones, new laptops and whatnot. So something similar happens in the economy, that if a lot of money is printed, that money is going to flow to people one way or the other, and they end up buying more and more stuff. This is called as increase in liquidity, and this leads to higher inflation in the economy. Now, just to help you understand where we are standing in terms of inflation, these are the numbers for the US, and you can still see that the inflation in the US is still very, very high. So as a result, one of the mandates for RBI or Fed in the US becomes what? It becomes to control inflation. And how do they control inflation? And they control inflation by increasing the interest rate. Now, in that previous example of repo rate, you can imagine that if RBI suddenly spikes the repo rate from 3% to 4%, what is going to happen in the economy? They are going to borrow less money. Why? Because if the interest rates suddenly go up, will you be taking more home loans or will you be taking more car loans? The answer most likely would be a no. So under such circumstances, there is contraction of money supply, which will bring down the inflation. And how did this money supply get contracted or it became less? It simply became less because RBI or Feds decided to push the button called as the interest rate change. So whenever RBI or Feds decide to increase the interest rate, it leads to contraction of money supply and therefore bringing the inflation down. So now you might have a natural question that, okay, this looks like a very simple step, that hey, if we want to decrease the interest rate, just call up RBI, tell them to increase the interest rate, and there you go, boom, the inflation comes down. But it is not as simple. So this brings us to a brief story of Paul Volcker. So Paul Volcker was the chairman of Fed in the US back in the late 70s and early 80s. And back during the day, the inflation in US was very, very high. For example, the inflation in the US was close to 14-15%. So as a result, Paul Volcker has a big challenge ahead of him. So he decided that, you know what, that I'm going to continue to increase the interest rate in a very sharp manner. And he did a series of interest rate hikes. As a result, they were able to bring down the situation of high inflation in the economy. Now, on one hand, you might appreciate the efforts of Paul Volcker, but on the other hand, this also led to catastrophic events for the economy in the US. There was almost a decade of very low growth in the US, and it significantly hurt the US development. So it is very easy for us to say today in 2022 that, you know what, we are again going in that Paul Volcker way, that inflation right now is very high. So it is a very obvious thing that RBI is going to increase the interest rate at a massive pace. Similarly, the US Feds are going to increase the interest rate in a very massive way, and we will bring the inflation down. This looks like such an easy thing, but guess what? You are incorrect. This is not such an easy thing because there is a cost that has to be paid. If the Feds or RBI right now decide that they are going to just continue to increase the interest rate, the economy will suffer. Why? Because the credit flow in the economy will shrink. So this brings us to the core of the video, and this will help you understand whether you should be putting in more money right now in the market or you should just stay put and not put any more money. So the question is that are we going the Paul Volcker way in 2022? So let us recap the facts very quickly. So here is the inflation chart, and you can see that the inflation in the US is very, very high. The Feds are increasing the interest rate in a sharp manner. Point number 3, we also know the fact that if the Feds go the Paul Volcker way, then the growth of the economies will suffer a lot. So this brings us to my hypothesis as to why the markets are not going to tank from this point on. So there is always a tug of war that goes on between RBI, Fed and governments on the other side. What is RBI, Fed's mandate right now? It is to decrease the inflation in the economy. And how would they do it? They would do it by increasing the interest rate. But if they increase the interest rate, what happens to the growth of the economy? The growth slows down. This is what we have understood so far. Now, what is government's mandate? For example, if you go and check with Joe Biden's administration or Modi ji's administration, what are they most concerned about? They are most concerned about the growth of the economy. Why is that? Because they have to win elections. So every time the Feds or RBI decide to increase the interest rate, they have to do it in conjunction with permission from the government. It is not as if that Feds and RBI can take an independent decision to put interest rate whatever they like. So now you would have a very natural response that, okay, back in the 1970s, early 80s, the Feds increased the interest rate very, very sharply. Now, why do you say now that we will not go the Paul Volcker way in 2022? So here are two reasons for the same. So first comes from this particular chart, and this shows the GDP growth history from 1930 onwards. What you will see is that in 1930s, 1940s, there used to be this wide fluctuation in GDP growth rate. That some years the GDP growth rate was very high. Then in some years the GDP growth rate was very, very slow. So on and so forth. Then let's continue the story. Take a look at this particular block. What you will see? You will see that the GDP growth rate is still fluctuating and there are wide ranges, but not as high as it was in this zone. Now let's move on to 2008 onwards. What you will see is that the GDP growth rate change has almost been stable. For example, take a look at this particular part from 2018 to almost 2020. The GDP growth rate was extremely stable. This is the crux of the issue, that why do you think that the GDP growth rate has been stable as of now? The reason there is very simple, and let us compare two timelines. So back in the 1970s, imagine the type of generation that used to live. They had to live through wars. For example, World War I, World War II. They lived through Great Depression. So people, whoever were surviving in 1917, 1980s, they had to go through a lot of tough time. Even in India, we had to go through partition, emergency-like situations, whatnot, right? So people there were very, very tough. They were open with governments taking very harsh stand. Now, flash forward to 2022, we are in a situation where people have become a little bit soft. If we don't get our food in 30 minutes, we start creating ruckus. And now I know that some people in the comment section would start creating ruckus that, you know what, this video itself is too long. So what is government's objective? The government's objective is to pander to the crowd or keep the people happy. In 1970s, 1980s, the generation was such that they could handle really difficult things. But in 2022, if GDP does not grow for 2 years, people will start creating a lot of ruckus. So this is reason number one why I feel that there will not be massive fluctuation in GDP growth irrespective of what happens. Now, second key reason that right now in the economy, government controls all the cards. You might have often heard of a phrase that please do not bet against the Fed. Where did this term come from? It literally came from the fact that, hey, do not take positions in the market that do not align with Fed decisions. Think about it this way, that right now government tells you where you can invest. For example, these days it is getting increasingly difficult to invest in gold. All the NBFCs are heavily regulated, private banks are heavily regulated, all the fintech companies are heavily regulated. To cut the long story short, government controls the entire economy. And there is a simple switch that they control, which is the interest rate switch. By moving that around, they can control the amount of money that flows into the economy and the amount of money that comes out of the economy. And they use it as a simple tool to keep the people happy. Back in the 70s, people were much more resilient and government did not have absolute control over the economy. Now with monetary supply completely in government control, governments have 100% control over the economy. Therefore, you can't bet against the Fed. So this brings us to the final point, that how do I see the markets transitioning from this point onwards? So number one, the long-term trend of a sideways market is still very much intact. We will keep on moving from that 17,200 levels to almost 18,400 levels. Point number two, in this entire sideways movement, there will be sector rotation that will keep on happening. For example, recently you would have seen that the Bank Nifty reached its all-time high. There was some profit booking that was done on Friday on Bank Nifty in India, and a lot of finance-based stocks fell. This does not mean that they are forever fallen and they will not bounce up. They will of course bounce back up. So just buy them at the dip and keep trading that channel. Similarly, there will be sector rotation that will keep on happening on large cap, small cap, mid cap stocks, different sectors. So all this sector rotation is happening in the market, and it will keep on happening because that is the fundamental nature of a sideways market. Now comes the final question, that hey, when will a breakout or a major breakdown will happen in the economy? So let me comment very briefly on the same. So I don't think that a major breakdown will happen. Now what do I mean by major breakdown? It means that more than a 10-15% correction, that is unlikely to come because we are not ready to handle such a shrinkage in the economy right now. So what about a breakout? So breakout will happen when we decisively cross that 18,200, 300 levels. So when is that exactly going to happen? So to cut the long story short, no one knows when is that exactly going to happen. If I have to give my prognosis and take a complete wild guess, then I would say that it is very likely to happen in the next 6 months. There are a lot of technical patterns that are forming, especially on finance stocks right now. For example, HDFC has barely moved in the last 5 years. It has not given much returns. And if the Nifty has to break 18,300, 400 levels, then something like HDFC needs to run. So I am quite bullish still about these type of companies that are still giving out highest ever revenues, highest ever profits, and are still somewhat undervalued. I will also make a separate video on this topic. What are some of the undervalued opportunities that I'm finding in the market? And I will keep you posted. I hope you enjoyed this video. Please press the like button so that it reaches out to more people, and I will see you soon.